Thanks for tuning into this edition of Talking Point. And let's just set the stage. There is a bearish mood in the market, and some of the reasons why this could be the case: weak Q2 results, the GDP outlook seems to have come off, and a lot of private economists or private sector economists have actually spoken about how Q3 might be weak as well. There are concerns over valuations, and they always continue. So one reason is the GDP outlook lowered. Let's move on to the other reasons as well. Consumption concerns have mounted, and that has always been something that is people are now starting to talk about after Q2 results. And last but not the least, the rate cut uncertainty in the US. I think that is probably the big one. And let's get in our guests to talk about the same. Rajiv Batra of JP Morgan with us to talk about his thoughts on what's currently happening. Rajiv, great having you and to you and yours out there in Singapore. A very happy Diwali and a prosperous new year. Good talking to you today.
Thanks, Niraj. Happy Diwali to yourself, your viewers too.
Thank you, Rajiv. Now, Rajiv, I remember a conversation that we had at your investor conference wherein you had mentioned that things may wobble a bit in October, but they may change for the better post-October. I would love to understand, does the theory still hold, or does a possible reflationary trade because of a possible Trump victory change that outlook a little bit?
No, all the points which you have just mentioned a few minutes back, this is what we were alluding to when we came out with our report back in August and September, that this is the period in October and November where we will revisit. Markets will take a breather, some consolidation will there. And most importantly, you will be seeing a furious rotation at a sectoral level where you will not have any clue whether we are moving defensive or cyclicals or large cap or mid cap. That's the phase we are in right now. But the good part is a sizable amount of a correction is over, and maybe a 5% down the line from here will get India back to the trend valuation, which most of the foreign investors and long-term investors are eagerly waiting for. At the same point of time, whether it will be a red sweep or a blue sweep, neither of them in the sweep scenario have talked about a fiscal consolidation. They are still talking about a fiscal support, which will be positive for the risky asset classes, global equities overall. That's a different point, who will outperform and who will underperform. But just jog your memory back to 2017. Once the 2016 election was over, we saw 35% return in EM equities and close to 20 to 22% return in DM equities. So people who are extremely bearish on the markets or even on India needs to be a bit cautious from here on, taking that kind of an opinion and sentiment for 6 to 12 months basis.
Interesting. So Rajiv, sorry, am I getting this straight that you say that at these mean valuations, assuming there is a 2-3% further correction, would you be a buyer? Part one is that. Part two, flows, Rajiv, is the big thing, right? Over 1 lakh crore of outflows in October. Now, do you believe that can reverse in November? Because I remember back then in September, you were talking about a possibility of large global funds moving into emerging markets like India. Can you talk a bit about that? Flows.
Yeah, and after a chat, we saw what happened in a day or two. China unleashed one of the biggest stimulus packet and support to the markets. So that's where the first installment of outflows happened in India, where not only foreign investors started neutralizing their overweight on India and going to making China a marginal underweight or a neutral territory, but even the domestic investors in India were subscribing more to China-based fund in the first week of October. So that was the first jolt India received. After that, to put entirely blame on that money is rotating from India to China is absolutely a wrong notion, because we have seen money have been going back to the US or precious metal like gold, silver, even some places cryptos too. So the US election uncertainty, and most importantly, the stronger data points started coming back into the US market that made people shift towards dollar asset class, and hence India, which was one of the well-owned market along with some few other markets in EM by foreign investors, that gone into a profit booking kind of a mode overall. Now, can money make a comeback over here? My answer is absolutely yes. Remember, nobody was giving a chance of India getting FI flows while we were going into the Indian elections in June. But what we saw after the election result, from June early start onward till almost till September end, India received $16.5 billion inflow in matter of 3 to 4 months. So once the risk of sentiment goes away, markets get a clarity who is the US president, who controls the US Congress. We get the clarity from Fed to what kind of a cycle or a path they are adopting to. I think the normal service will resume in market. For now, coming up from a very high level with kind of a returns which India along with other markets like Taiwan, Malaysia, even with US equities they have generated, there is an expectation of some kind of a breather and consolidation in market happening, and we are exactly right now in that situation. Does the long-term path change for India? Absolutely no. We continue to maintain our structural overweight on Indian equity market.
Rajiv, hi, good morning. Tamanna here. Uh, the tough bit right now is to quantify when does this long-term structural overweight outlook kick back in? When does this period of uncertainty end? Do you think that the rebalancing that you talked about in favor of China is at the fag end of its process, or there's more pain to go?
So first answering on China. So in case of a China, the process is still on. As we are talking, they will be going into the policy making meeting next week, and there are a few more meetings to come in December. China definitely is trying their level best to come out of the problem which they are facing in equity markets, in terms of a higher debt level, or in terms of a real estate markets too. So they will try to, they do their level best to generate a higher growth and resolve this issue. JP Morgan has revised this current quarter GDP growth in China higher to 6.9% quarter on quarter basis, and even for the first quarter next year we are calling for 5% growth. But beyond this near term jump in growth, we still believe headwinds persist in China, and that is the reason why our advice to investors have been to be neutral on China, which means they will keep on looking for a sustainable growth places or countries which can offer them earnings visibility and clarity, not from 1 or 2 quarter perspective, but at least for 3 to 5 years perspective. That's where India sits. Now, what can give back that confidence to investors that India is on that path? We definitely need to see high frequency indicators start moving up. Recently, we saw a 40-month low GST print, a kind of a year and a half low PMI prints over there. So that data points came down in terms of heavy monsoon season which we have, which impacted demand, and then lower spending from government due to elections and then monsoons. But all these factors are going to change, where we do see government spending expected to pick up in the second half of this fiscal year. The cyclicality of rural consumption have not been clicked in yet. That will also start with ongoing festive season plus marriage season that will become. And last but not the least, the base effect. Remember, now your first half base effect is quite low. So even if you perform little bit higher over there, the amount of jumps in the growth in Q on Q basis in third quarter, in fourth quarter will be way significantly higher. So I will again caution, you have seen the negativity in first quarter, second quarter, but don't extrapolate it to the second half of this fiscal year, because we do anticipate second half of this fiscal year growth will kick back along with some support from private capex too.
Hi, it's also Samina joining in. Domestic investors have a home bias. So what should long-term investors do? While nobody argues, or there is a clear consensus that we are in a structural bull run, intimate volatilities are very difficult to stomach if you're a long-term investor, right? So what should the strategy be? Buy more into this weakness? If yes, what do you buy? Do you buy banks? Do you buy consumption? Do you buy IT? I mean, the universe is large, though restricted and limited for most investors to India.
Thanks, Amina. I will say that the Indian equity investors are quite smarter, the domestic investor, because we have seen they only follow one factor of investing into the market, and that is earnings and earnings momentum. So there are spaces where there's a structural kind of a support in terms of an earnings and growth. So power is one such ecosystem and theme that will keep on doing well for multi years overall. Similarly, on the healthcare side also, but on the other spaces, as you mentioned, be it financials or consumption, there will be some cyclicality clicking in. Right now, we have seen a cyclicality clicking in for consumption also. We had very good second quarter in terms of performances, or even early third quarter also for consumer staple sector. But as earnings kicked in, consumer staple sectors and defensive started going down overall. But does it mean that theme is over? That theme does not have leg? When we look at the macro indicators, the GDP per capita, or when we look at wages or rising in incomes overall, that still remains supportive as a theme. So the only lens we should apply on is earnings, and taking that into account, there are some structural themes and there are some cyclical themes. Beside power and healthcare, I will say even the capital market intermediaries, because even today, the household balance sheet is not fully exposed towards equity and equity-linked investment. So capital market intermediaries will be do well. And then based on the cyclicalities of earnings, the tailwinds are behind your IT sector. There is some tailwinds behind even your industrial spaces or cement spaces overall. So that's what the GOS people will need to do in. And I will say that if one needs to invest in the market, it has to be in a regular, healthy SIP, or you can say in investment monthly or a daily or a weekly kind of a mode, so that that healthy practice remain. Because India's GDP growth is expected to remain above potential, at least in a relative term compared to the other EM markets, other Asian markets, which means the risky asset class in India will keep on doing well relative to their global EM or a DM counterparts.
Just, you talked about where the tailwinds are, but in the context of the quarterly numbers as well, where do you see the largest pain points or any areas of concern?
So I'll say too early to say on earnings right now, because so far this mid cap has not even started. We have large cap largely in, and most of them were IT spaces who have given the earnings. So definitely revenue, if we look at X financial, is still disappointing. YOY basis, it's almost flatlined over there, and in line with the expectation, earnings, that is bottom line on a YOY basis, are only X financials 2% up, but disappointed based on the JP Morgan forecast, which was plus 3%. That's the ongoing run rate. We will see how the earnings progress overall. But the top line disappointment coming is a concern. And we hope that it's an aberration just for first half of this year, and things start improving in the second half on the top line side, because margins will be difficult to defend if you don't have much support from factors of production, particularly from input prices. So hence, this is the reason why I'll say top line for slowing down is more a concern for me in this ongoing earnings season.